Suyash Chaudhary, who's head of fixed income at IDFC, joining us live on the show. Suyash, to begin with, all of you in the markets had expected, something like 60 to 65% of the overall borrowings being front-loaded into the first half of the financial year. That's exactly what we've had come out from the finance ministry yesterday. So why is the market today reacting so strongly? You've seen the yield on the 10-year bond go up to as high as 8.6%.
Well, the borrowing number is definitely on the higher side of market expectation. Like you said, the average expectation was 60 to 65%. Also, we are starting off right away with an 18,000 crore auction, so which is why the market doesn't find space to be able to liquidate before the auction schedule hits. Also this week we are looking at an SDL or state loan auction of 6,500 crores. So all told, from here into RBI policy, the supply is significant. And what the market is essentially doing is offloading existing positions, possibly creating a bit of shorts to be able to cover in the days ahead.
If we focus, Suyash, more on the yields, they've risen close to 22 basis points since the 15th of March. Of course, it hit the 3-month high just yesterday of close to 8.6%. Do you see it remaining in this kind of a zone for some time?
Look, GSEC yields, typically move to net supply. So even the move from September, October of last year to mid of February this year from 9 to 820 was more a function of RBI stepping in with OMOs and taking out net supply from the market. So we were always of the belief from April bonds would be under pressure. At the very least, they would have underperformed shorter end rates. As we see it in the month of April, the only real trigger to look forward to is possibly RBI rate cut on the 17th. If that were to happen, then possibly bond yields would stay in the range of 860 to 875. However, if RBI were to disappoint on 17, then a move higher also cannot be ruled out in the very near term. Over second half of the financial year, we would actually be constructive on bond yields, because that is when typically we would expect the OMO program to restart owing to liquidity considerations, and that may be a better time to relook at investing in GSECs.
Right now, Suyash, just looking at the borrowings calendar that the RBI has put out, everyone was expecting that April, May would be fairly heavy borrowing months simply because of the redemptions coming through in those 2 months, something like 60,000 crores. But if you look at the month of August, on average, there's something like 75,000 crores that the RBI is looking to borrow. Do you believe that month the bond markets are going to see a fair bit of pressure, or would you believe by then we will have seen possibly 2 repo rate cuts come from the RBI, so yields would have cooled to possibly 8.3, 8.4 levels?
No, precisely. So by August, like you say, at least 1 to 2 rate cuts should be through, and that should keep or maybe serve to bring down 10-year back into the 8.5 to 875 zone. For it to move lower, either the quantum of repo rate cuts have to be higher, or the OMO program of the RBI has to begin sooner than last year when it began in November.
So Suyash, when you say that all those 2 rate cuts will bring yields down to the 8.5, 875 level, are you today penciling in the likelihood of the yield on the 10-year bond going all the way to possibly 9%?
In the absence of 17th April rate cut, yes, I won't rule out a band of 875 to 9%. However, there are some automatic stabilizers as well. So, there are large bond redemptions due in April and May. That would create some bit of replacement SLR buying as well. But in the absence of a rate cut, yes, I won't rule that out.
Sure. And if we were to talk about the way the rupee has been behaving, it has been under pressure. Do you believe that intervention of the RBI, how that will likely impact the liquidity in the system?
Yes, that's in fact a very big variable to be keeping track of. So on its own, without further interventions, in April, system liquidity should head back towards around negative 75,000 crores or so. But even in the last week or so, we have seen signs of RBI intervening. So, we have data till January where an intervention is to the tune of $20 billion. If even half that pace were to continue, that would have large liquidity implications and may bring forward the OMO program for the financial year. So for us, the biggest trigger to watch out for more than rate cuts when we are taking a view on G-Secs is when the OMO program starts.
Right, but again, Suyash, you said that you expect the deficit to drop to something like below 75,000 by April. What are you basing that on? Because currently the deficit is running at about close to 1,80,000 crores. Do you believe we will see that much of government spending, that much of transfers to state governments, that the position will drop significantly?
Yes, so the 1,80,000 crores of negative liquidity, corresponding to that, the government is maintaining a positive cash balance with the Reserve Bank of India to the tune of 70,000 crores, and that is because of advance tax collections. Now, seasonally, we see in April the government going in deficit mode with RPI to the extent of at least 20 to 30,000 crores. This year, it may be more because they have to fund bond redemptions early April. So, from plus 70 to minus 30, you are looking at a 1 lakh crore swing in government's balances with RBI, which is that much more liquidity to the banking market. So this 1,80,000 going to 75-80 is very possible, owing only to the swing in WMA. However, one has to qualify that by late April to early May, system liquidity should head back towards the minus 1 lakh crore zone.
All right, Suyash, many thanks for coming in on the show and walking us through the outlook for the bond markets going forward. As we speak, the yield on the 10-year benchmark bond has risen to 8.6% on the basis of the borrowings calendar that has been put out.